Knows that foreclosures on average across the United States are taking about 600 days.
600 days.
Right, so that you do have time. I wouldn't suggest that you wait, okay? The instance of being referred to foreclosure means that you are very far down the delinquency path.
90 days or more?
At least. It's state dependent. The note really drives when you're allowed to refer loans to foreclosure. Under the Making Home Affordable program, you're not allowed, meaning the servicer is not allowed to refer your loan to foreclosure until they have given you a solicitation offering you the option to be considered for the government Making Home Affordable program. You have to send in your paperwork and go through the qualification process. And if you don't send in your paperwork within a certain period of time, as dictated on the forms, they may proceed down that path, because they've given you the required option. So don't wait until you're that late. But if you're already there and you haven't made connection with your servicer, it is not too late to pick up the phone and call the servicer, get your paperwork together, know what your income source is, or if you don't have an income source, think about the short sale option. It's very important that homeowners talk to their servicers before they list the property for short sale.
Okay.
I mean, many people get into trouble with their mortgage. They think, okay, I'll just sell the house. And they really believe that they always have to list it for at least the outstanding mortgage balance. And that's not always the case. Unfortunately, as real estate agents know, once you list that house and it gets stale because people are going in it and not making offers, you start lowering the price and lowering the price and lowering the price, all of a sudden it stops being looked at. So you might as well speak with your servicer first to determine if you're eligible for a short sale and get the market value that the investor will accept, because the investor has to either give the servicer approval or approve it themselves. That way you start off on the right foot with your short sale. So it's not always necessary to think that you're all by yourself. It's never necessary to think that, and that you just have to call an agent and put your house up and you know, shoot from the hip. Make sure that you explore the short sale option, especially in these interest rates. It's a buyer's market with these interest rates the way they are. Housing analysts are saying that we're kind of close to the bottom, bumping along for a while.
Right.
So it's probably a very safe time if you're looking to buy a home, and if you're looking to dispose of your home through the short sale process, makes an attractive option for new home buyers.
Ingrid, you held the title of Senior Vice President with Freddie Mac. What role does Freddie Mac play in all of this? What are their functions?
Freddie Mac and Fannie Mae are part of the secondary market infrastructure. The secondary market infrastructure was designed to create liquidity in the mortgage market. And what that means is National Bank of Mark Rigney, savings and loan, let's say, before the savings and loan crisis, would talk to a borrower who came in who wanted to buy a home, right?
Right.
And you'd give them a 30-year mortgage. So Mark sat on that 30-year mortgage, made a lot of compounded interest, but had 30 years before they could just, you would have new money.
Right.
So let's say you gave them $150,000 and then you compounded the interest and then you wait for that to come. At some point, Mark may run out of money. Now, with the secondary market, and it's not a new phenomenon, but with the secondary market, you have people who buy that mortgage from you. You originate to the terms that they specify, and you warrant to them that you've done all of that, you've done the proper underwriting and all of that, and you lend the $150,000 from your bank, and then you sell it to them because you've made a commitment to sell it to them, and you're committing that it meets their representations and warranties, and then they give you the money back so that you can right away turn around and make a loan to that new person, the next borrower, or whoever comes down the road.
Keep the flow going.
Keep the flow going. So that's the liquidity portion of it. And then they, in turn, create securities, mortgage-backed securities, and get investors to invest there so that they can get money, so they can give you more money, and keep that money going in that cycle.
Some homeowners think that mortgage insurance should protect me from foreclosure. Yeah, share with our viewers the role mortgage insurance plays.
Mortgage insurance protects the owner of the note in the case of a foreclosure.
The owner of the note, meaning the bank.
That's right, the bank or the investor. It's really the investor. So
provides no service for the borrower.
Not really, no. And the reason that that is in place, mortgage insurance is primarily a vehicle of the government-sponsored agencies, Fannie Mae and Freddie Mac. So before you had to come up with 20% down payment. Well, there are many families in America who do not have familial wealth don't have access to that kind of money, and this is before all of these silent seconds and all of that. And so there's a whole segment of the population who are very, very good renters, who are putting a lot of money out of rent.
Good credit.
They had excellent credit, but were not able to get mortgages at conventional rates. FHA has been around for a long time, and that has an insurance premium associated with it too that does the same thing as private mortgage insurance. It protects the government in the event of default. So if you don't have 20% down, the agencies have high loan-to-value mortgages, 95% and whatnot.
Right.
Exactly, which requires a much smaller amount down. The FHA program is like a 3% down. And that really helps to provide affordable financing for homes to a lot of the population who are worthy of owning a home and building generational wealth. So before this crisis, home ownership has been the primary mechanism by which the middle America, the rank and file, the affordable borrower builds generational wealth. Those of us not born with the silver spoon and have grandfathers and whatnot that pass money to us. And it didn't seem fair to keep them out of that market. Mortgage insurance allows the government-sponsored agencies to take that higher risk. So if you go into default, not because you weren't properly qualified before, but let's just say you do go into default, the mortgage insurance covers that top portion of the mortgage, okay? So traditionally, you don't put your 20% down, you get a 95% loan to value. That means that there's kind of a 15% exposure, it's 5% equity. If that loan goes into default, the mortgage insurance company covers the top 15, 20% of the mortgage. Each of the plans are different depending upon the loan to value ratios of the mortgage. And it's there to protect the investor, the person who owns the note, against loss, and that way they feel more comfortable being able to lend at those levels with such little equity down.
Okay. You mentioned HAMP and HARP.
Yes.
What are they, and explain the difference between the two for our borrowers.
Sure. The HARP is the Home Affordable Refinance Program, and HAMP is Home Affordable Modification Program. HARP is primarily and only used to refinance and with performing loan borrowers who are current on their mortgage, who are facing some sort of imminent default. It's pressing, it's right there. Death of the primary wage earner, divorce, long-term disability, something like that, okay? The HAMP program is the modification program. It's primarily used in situations of defaulted borrowers. Under the HAMP program, you call your servicer and you say, this is my situation. They've probably already contacted you because you've become 30 days delinquent, and you're looking for a solution because you want to retain your home. HAMP is a home preservation option. So you have a job, maybe you have experienced a reduction in your salary or whatever, but you can afford to make a mortgage payment, just not the payment that you had yesterday or that you're currently behind on. So they qualify you to determine where your mortgage is in relation to your gross monthly income. So that's before taxes and insurance, you know, your health insurance and all of that. What they're looking to do, because studies have shown that, allocating about 31% of your gross monthly income seems to be a sustainable place for most people to be. And it's only for your first mortgage.
Okay.
Doesn't do your second mortgage. There is a second mortgage program in the Making Home Affordable product suite.
Okay.
But the HAMP itself is to address your primary mortgage.
Okay.
And they're looking to create affordability. A study just came out that showed that in the HAMP program, 82% of those modifications had a 10% or more reduction in your monthly mortgage payment. And that's really, that really does create affordability. It frees up more cash to pay other bills. It allows you to make your mortgage payment on time and things like that. It also showed that the home affordable modification mortgages that have been made since the program started are reperforming, meaning that these borrowers are staying current at a higher rate than the proprietary programs that are offered by the bank.
Okay.
Part of the reason, I believe, is because not only do the servicers get incentives to make these mortgages, incentives are fees that they get paid by the Treasury to make modifications when they can, when it makes sense. The borrower does too.
Okay.
And those incentives that the borrower gets after 12 months of on-time payments can go to reduce your principal. So again, you get an opportunity to regain your equity position.
Okay. We only have a minute left, Ingrid, but is it a bait and switch if a homeowner applies for one of those programs, but the servicer offers one of theirs instead?
No, not necessarily.
Okay.
Now, you want to make sure, because like I said, the HAMP program has the incentives, right?
Right.
For you, and you want to be able to take advantage of that program if you can. If the loan is serviced or owned by Fannie Mae or Freddie Mac, they're required to qualify you for the HAMP program first. And you want to make sure that you understand that when you're talking to your servicer, if they tell you no, that they need to make sure that they give you an explanation so that you can be comfortable that you really and truly didn't qualify. If you need to talk to a counseling agency, they're free on the HUD website. Talk to them about what you received, that you were turned down for the HAMP, but you were offered a modification through the bank's program. Those are not bad modifications. They've done about 4 million of them since the crisis began in 2007. But you want to make sure that that is the right product for you if your intention is to keep your home.
Ingrid, thanks for being here and sharing this very valuable information with our viewers. Appreciate it.
Thank you.
I would like to thank our guest, Ingrid Beckles, for being here today and sharing her expertise. Now, we realize we have just thrown a lot of info at you and that you may have questions. If you do have some questions, please visit my website at markrigney.org, or you can email us. Our emails will be listed on the screen below. We will read and answer some of your questions on our next show. On behalf of my friend and colleague, Ingrid Beckles, thank you for watching Mortgage Solutions with Mark Rigney. We will see you next time.